My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 5 first important short question is: what are the components of working capital? Components of working capital. Working capital means the difference between a company's current assets and current liabilities. It shows how easily a business can run its day-to-day operations. Components of working capital. 1. Current assets. These are short-term resources that can be converted into cash within a year. Cash and bank balance for daily payments. Debtors accounts receivable, money customers owe. Inventory stock, raw materials, finished goods. Short-term investments. Example, a shopkeeper's cash, goods on shelves, and money to be received from customers are all current assets. 2. Current liabilities. These are short-term obligations that must be paid within a year. Creditors accounts payable, money owed to suppliers. Short-term loans. Outstanding expenses, like salaries, rent. Example, the shopkeeper's dues to wholesalers or pending electricity bill are current liabilities. In short, working capital is equal to current assets, current liabilities. It helps a business run smoothly, just like pocket money helps a student manage daily expenses. Next important short question is: 2. Distinguish between gross and net working capital. Gross versus net working capital. Working capital is an important concept in financial management, but it can be understood in two ways: gross and net working capital. Gross working capital, GWC. It means the total of current assets. It shows how much money a firm has tied up in short-term assets like cash, debtors, and inventory. Example, if a shop has 50,000 rupees in cash, 30,000 rupees in stock, and 20,000 rupees in debtors, then GWC is equal to 1 lakh rupees. Net working capital, NWC. It means current assets, current liabilities. It shows how much liquid funds remain after paying short-term obligations. Example, if the shop above has current liabilities of 40,000 rupees, then NWC is equal to 1 lakh rupees to 40,000 rupees is equal to 60,000 rupees. Key difference. GWC focuses only on assets, like total pocket money. NWC shows the real free money after paying dues, like pocket money left after settling hostel and mess bills. Next important short question is: 3. What is cash planning? Define cash budget. Cash planning and cash budget. Cash planning. Cash planning means deciding in advance how much cash will be needed in the future and how it will be arranged. It helps a business avoid cash shortage, not enough money to pay bills, or excess idle cash, money lying unused. Example, a college canteen owner plans cash for buying raw materials, paying staff, and meeting rent on time. Cash budget. A cash budget is a detailed estimate of cash inflows, receipts, and cash outflows, payments, for a specific period. It shows whether the firm will have surplus or deficit cash. If there is surplus, the firm can invest it. If there is deficit, the firm can arrange loans in advance. Example, suppose a company expects 2 lakhs rupee sales collections and has to pay 1,50,000 rupee expenses in a month. The cash budget shows a surplus of 50,000 rupees. In short, cash planning is equal to thinking ahead, cash budget is equal to written plan in numbers. Next important short question is 4. What are marketable securities? Mention any two characteristics of marketable securities. Marketable securities. Meaning. Marketable securities are short-term investments that a company makes to park its extra cash safely. They can be easily sold in the financial market and quickly converted into cash when needed. Example, a company may buy treasury bills or commercial papers with surplus cash. If it needs money urgently, it can sell them in the market and get cash. 2 characteristics. 1. High liquidity. They can be sold or converted into cash quickly, usually within a few days, without much loss of value. Example, a treasury bill can be sold in the money market anytime. 2. Low risk. They are safe investments as they are generally issued by the government, banks, or reputed companies. Hence, the chances of losing money are very low. In short, marketable securities is equal to temporary parking place for extra cash with safety plus liquidity. Next important short question is 5. Management of receivables, monitoring receivables. Management of receivables and monitoring receivables. Meaning, receivables are the money that customers owe to the business because goods services were sold on credit. Managing receivables means making sure that customers pay on time and the company's cash does not get stuck for too long. Management of receivables. The company sets clear credit policies, like how many days customers get to pay, checks the creditworthiness of customers, and offers discounts for early payment. Example, a shop allows customers 30 days to pay, but gives a 2% discount if they pay within 10 days. Monitoring receivables. It means keeping an eye on unpaid bills regularly. Tools like aging schedule, classifying bills as 30 days old, 60 days old, etc., help managers identify slow-paying customers. Example, if many bills cross 90 days, the company must act strictly to collect. In short, proper receivables management is equal to faster cash inflow plus lower bad debts plus smooth working capital cycle. Next unit we. Long questions, most important. First important long question is: explain the determinants of working capital needs. How is the operating cycle approach used in estimating working capital? Determinants of working capital and operating cycle approach. Meaning, working capital means the money needed for a business to manage its daily activities like buying raw materials, paying wages, storing goods, and giving credit to customers. It is calculated as working capital is equal to current assets, current liabilities. The need for working capital depends on many factors. Determinants of working capital needs. 1. Nature of business. Trading businesses like supermarkets sell goods quickly, so they need less working capital. Manufacturing companies, like car or steel industries, need more as production takes time. 2. Size of business. Bigger firms generally require more working capital, but they also have better access to bank loans and credit. 3. Production cycle. Longer the production process, higher the working capital needed. Example, a textile mill needs more funds than a bakery. 4. Seasonal demand. Industries like sugar or ice cream need huge working capital during the season but less in off-season. 5. Credit policy. If a company sells goods on long credit, say 60 to 90 days, it needs more working capital. Example, a furniture company giving installment sales needs more funds. 6. Business growth. Expanding companies need more inventory and receivables, hence higher working capital. Operating cycle approach. The operating cycle explains how long it takes for a business to convert cash raw materials finished goods sales cash again. Steps in operating cycle. 1. Raw material storage period, holding raw materials. 2. Processing period, converting raw materials into goods. 3. Finished goods storage period, waiting to sell goods. 4. Debtors collection period, waiting for customers to pay. 5. Less creditors payment period, time taken to pay suppliers. Formula. Operating cycle, OC, is equal to RM storage plus processing plus FG storage plus debtors, creditors. Example. If RM is equal to 30 days, processing is equal to 20 days, FG is equal to 10 days, debtors is equal to 25 days, creditors is equal to 15 days. OC is equal to 30 plus 20 plus 10 plus 25 to 15 is equal to 70 days. This means the firm needs enough working capital to cover 70 days of expenses. Conclusion. Determinants explain why working capital is required, while the operating cycle approach gives a practical way to calculate how much is needed. Next important long question is: 2. Discuss the different sources of financing working capital, bank finance and trade credit. Sources of financing working capital, bank finance and trade credit. Every business needs working capital to manage day-to-day operations like buying raw materials, paying salaries, storing goods, and offering credit to customers. Since working capital is a continuous need, firms usually arrange short-term finance. Two major sources are bank finance and trade credit. 1. Bank finance. Banks are the most common source of short-term working capital. They provide funds in different forms. Cash credit overdraft. The firm can withdraw money from its bank account up to a certain limit. Interest is charged only on the amount actually used. Example, a textile shop with a 10 lakh rupees overdraft limit withdraws only 6 lakhs rupees, so interest is charged on 6 lakhs rupees. Short-term loans. Banks provide direct loans repayable within 1 year. This is useful when firms need lump sum money. Bills discounting. If a company sells goods on credit, it can take the bill, promissory note, to the bank and receive cash immediately at a discount. Example, if the bill is worth 1 lakh rupees, the bank may give 98,000 rupees now and keep 2,000 rupees as discount charges. Advantage: flexible, quick, and reliable source. Disadvantage: requires good credit history and collateral. 2. Trade credit. Trade credit means credit given by suppliers of goods. Instead of paying cash immediately, the firm is allowed to pay after a fixed time, say 30 to 90 days. Example, a mobile shop buys phones worth 5 lakhs rupees from Samsung on 60-day credit. The shopkeeper can sell the phones and pay later from sales revenue. Advantage: no interest cost, improves cash flow. Disadvantage: if payment is delayed beyond due date, suppliers may stop further supply or demand higher prices. Conclusion. Both bank finance and trade credit are essential for smooth business operations. While bank finance provides flexibility and larger funds, trade credit works like an interest-free loan from suppliers. Most companies use a combination of both to manage their working capital effectively. Next important long question is: 3. Explain cash management. What are its objectives, techniques, and processes? Cash management objectives, techniques, and processes. In simple words, cash management means planning, controlling, and handling cash, both inflows and outflows, to ensure a business never runs short of money for its daily needs. Just like a student manages pocket money to balance expenses and savings, companies manage cash to balance operations and growth. Objectives of cash management. 1. Liquidity. Ensure enough cash is available to pay salaries, suppliers, and bills. 2. Profitability. Avoid keeping too much idle cash, which earns nothing. Instead, invest surplus cash in short-term securities. 3. Safety. Invest only in safe, liquid instruments. 4. Cost reduction. Minimize transaction and borrowing costs. Example, a company must pay 10 lakhs rupees salary on 1st of every month. If it keeps 50 lakhs rupees idle in bank, money is wasted. Instead, it can invest 40 lakhs rupees in short-term deposits and earn interest. Techniques of cash management. 1. Cash budgeting. Estimating future cash inflows and outflows to avoid shortage or surplus. Example, predicting festival season sales to arrange extra cash for raw materials. 2. Speedy cash collections, encouraging quick payments from customers through discounts or digital payments. 3. Control of cash payments, paying suppliers on due dates, not earlier, to utilize cash efficiently. 4. Investment of surplus cash, short-term investments in treasury bills, mutual funds, or bank deposits. Process of cash management. 1. Forecasting cash flows, estimate monthly receipts and payments. 2. Planning cash needs, decide minimum balance required for safety. 3. Managing surplus and deficit, invest extra cash or borrow funds if shortage arises. 4. Monitoring and controlling, regularly compare actual cash flow with budget. Conclusion. Cash is like the lifeblood of business. Poor cash management may lead to insolvency, even if a firm is profitable on paper. Thus, with proper objectives, techniques, and processes, companies ensure smooth operations and growth. Next important long question is: 4. Discuss the credit policy and the methods of evaluating creditworthiness of customers. Credit policy and evaluation of customers' creditworthiness. In business, not every customer pays immediately. Many buy goods on credit and pay later. To manage this, firms create a credit policy and check whether customers are trustworthy enough to give credit. Credit policy. A credit policy is a set of rules that decides: 1. Credit period, how long customers can take to pay, example, 30 days, 60 days. 2. Credit standards, which customers qualify for credit. 3. Credit terms, conditions like 2 tens, net 32% discount if paid within 10 days, full payment due in 30 days. 4. Collection policy, steps taken to collect money from overdue accounts. Example, a mobile dealer gives 30-day credit to regular shopkeepers but asks new customers to pay immediately. Methods of evaluating creditworthiness. Before giving credit, firms must check whether customers will pay back on time. Common methods are: 1. 5 Cs of credit. Character, is the customer honest? Does he pay bills regularly? Capacity, does he have enough income business to repay? Capital, does he own assets or savings? Collateral, can he give security, like property or shares, if he fails to pay? Conditions, what are the market economic conditions of his business? Example, if a cloth shop owner regularly clears old dues, has steady sales, and owns property, he is considered creditworthy. 2. Financial statements analysis, studying customers' balance sheet, income statement, and liquidity ratios to see if he has enough funds. 3. Credit rating agencies, using reports from agencies like CRISIL, ICRA in India for big customers. 4. Past payment history, checking how quickly the customer paid previous bills. Conclusion. A good credit policy balances sales growth with safety. If a firm gives credit carelessly, it may face bad debts. If it is too strict, it may lose customers. Therefore, carefully evaluating creditworthiness helps maintain both profits and financial health. Next important long question is 5. Explain the inventory management process. How do inventory control systems help in efficient management? Inventory management and control systems. In every business, inventory, stock of raw materials, work in progress, and finished goods is very important. If there is too much stock, money gets blocked. If there is too little, production and sales suffer. That's why firms use inventory management. Inventory management process. The process involves 1. Determining inventory needs, how much raw material or finished goods are required for smooth production and sales. Example, a bakery estimates how much flour, sugar, and butter are needed for the next week. 2. Purchasing and receiving, ordering stock from suppliers at the right time and receiving it. 3. Storing inventory, properly storing materials to avoid damage, theft, or wastage. 4. Issuing inventory, supplying materials to production or goods to customers as per demand. 5. Reviewing and reordering, regularly checking stock levels and reordering before it runs out. Inventory control systems. To manage stock efficiently, businesses use control systems such as 1. Economic order quantity. EOQ helps decide the optimal order size that minimizes total cost, ordering cost plus holding cost. Example, a medicine shop orders 500 strips at once instead of 100 each week, reducing transport and ordering costs. 2. ABC analysis classifies inventory into A. Items very costly, need strict control, example, diamonds for a jeweler. B. Items moderate value, need normal control. C. Items low value, simple control, example, pins, small screws. 3. Just in time, JIT materials arrive exactly when needed, reducing storage cost. Example, automobile companies like Maruti Suzuki use JIT to get parts only when required. 4. Perpetual inventory system, continuous record of stock levels through software barcodes. 5. Reorder level system. Fixing a stock level at which a new order must be placed. Conclusion. Efficient inventory management ensures that the company has the right stock, at the right time, and at the right cost. Proper control systems reduce wastage, avoid shortages, save money, and improve profits.